Hello and welcome to People Making Money, one of the Way to Wow shows. I'm your host, Kevin Bemmel, and we're here every Tuesday at 10 a.m. to talk about how to build our business and professional lives, how to build wealth, and all those subjects related to our financial success. So the title of the show, People Making Money, is a little bit tongue in cheek because it's not about people like Elon Musk, who have hundreds of billions of dollars or whatever. Most of us are never going to see anything like that. Rather, we focus on what we, the sort of typical people, need to do in order to reach our financial goals. So one of the central concepts that is necessary to meeting financial goals is to live within our means. And we can only live within our means if A, we know what our means are, and B, we know how we're spending our money. And so inevitably, we come to the issue of having a budget. So when I was a chaplain on active duty, and we were deployed on the ship, interestingly enough, a lot of my time was spent helping sailors and Marines with their personal finances. So you would think, wait a minute, you're on an aircraft carrier in the middle of the, I don't know, Indian Ocean, and you're a chaplain. Why are you talking about personal finances? And the reason is because for a lot of young people, as well as middle-aged and older people, the idea of dealing with finances, they had no training. They're not, they don't really know what to do, and the whole thing becomes a big, huge mess. And the next thing they know, they're saddled with a tremendous amount of debt that they cannot afford, and their whole life seems to be crumbling. And so, while it's all nice to talk about, praying to God and all that kind of stuff, when someone is worried about whether they're going to be able to pay rent and buy food, some of those other more spiritual topics don't seem to have a whole lot of meaning. So we would get down to, the realities of life. So what I'm going to do today is go over a basic budget and something that's very simple and that we can all do, and show you how to put it together. And I want a couple of sort of prefatory remarks. One is, while once you get into budgeting, it's very tempting to get ever more complex. The problem with greater complexity is that it takes more work to keep it up. So, what I advise you is keep your budget as simple as you can. The more of it you can keep in your head, the better. Okay, because that way it'll be easier to stick to it. Okay, and in the end, that's the point of having a budget. So to draw up a budget and then never look at it again is useless, really, right? Because it's not helping us establish any financial discipline. And that is the reason for having a budget, right? It's to establish financial discipline. Now, if you're married, then recommend you do this with your spouse. Now, in some cases, wife or husband may be the one who handles finances. And so then, if that's the case, maybe you don't need to have your spouse in on it. It's probably a good idea to at least go over it with them so they can understand how, you're planning to run finances. And if you have children, especially teenage children, I recommend that you don't need to go over the entire budget with them, but budget items that relate to them, whether it's cell phone costs or gas maintenance for the car, those kind of things, that they understand that these are budget items, and what's budgeted for them, we don't exceed those expenses each month, and therefore you're going to be responsible for exercising the same discipline that your parents need to exercise in order that the family lives within its means. So I prepared an outline of a simple budget, and I put it into Google Sheets, which is a nice convenient program for doing these kind of demonstrations. And you'll see here there are two budget columns. One is for personal and one is for business. So you may not have a business, in which case the business column, obviously you wouldn't have to fill it in. But if you don't have a business, then you'll see many of the expenses for your business that are in the business column here are going to become expenses in the personal column. And the reason I have this divided up is because indeed I do have a business, as you know, and there are a lot of tax advantages to having a business because of the kind of expenses that can be paid by the income of the business that therefore reduce your personal tax burden. So I'm gonna start out on the business side, and this is not going to be reflective of my life, but I do want to give you an example of how this would work, and you'll see certain numbers are going to be calculated automatically. So the first thing we need to do is look at what is the income from our business. Now, depending on the type of business you have, whether it's a service business or whether it's some kind of products business, so that will determine what your income stream is. But I'm going to go with a service business because that's simpler. If you have a products business, obviously then there's going to be some additional expenses. And in terms of calculating your income, you're going to start with your gross sales. You're going to subtract from that the cost of goods sold, which is the cost of creating your products. And so then you'll get down to your net sales. So where it says total income here, it would say gross. So actually, I'll put these in here right now. So you would have gross sales. Oops, I forgot let's take that out. Okay, let's go over here. So you'd have gross sales. Okay, and from that you would subtract cost of goods sold. Okay, and what you're going to be left with is net sales. Oops. Oh gosh. Okay, here we go. Third tries the charm. Okay, and so let's say, for example, that you had gross sales of $250,000. Okay, and let's say your cost of goods sold is let's say it's 125,000. So you're keystoning on your gross sales. So your net sales are going to be $125,000. Okay, and so then that would be in this the equivalent of your total income. Okay, so that's the main difference between a product and a service business. Now, if you're a service business, you may charge by the hour, you may charge by the job. I've got a little formula in here that's designed to calculate income from the business based on a weekly or a monthly basis. But let's just start with something simple. Let's say that let's just say that oops, I think I put it in the wrong one here. Hold on one sec. Yeah, okay. So let's say that you're making $75 an hour, and I wonder why that's not footing through. Okay, well, we'll put it in here. So you're making $75 an hour, okay? And you're working at your business, let's say you're working at your business 15 hours a week. That's weird. Oh, there we go. Okay, so the gross income or the total income from your business is a little over $56,000 a year. Okay. And that's, 15 hours a week isn't that much. That's 3 hours a day on average, or, maybe you work on weekends, you work 5 hours on Saturday and 5 hours on Sunday and a couple of hours during the week. Okay. So it's not a lot of time. This would be a side business in this case. Okay. All right. So, then let's look at your expenses. So let's say you have a car, okay, and again, I'm just going to be putting in some numbers to estimate it. But let's say, in terms of gasoline, you spend about let's say, $400 a month on gasoline. That may be a little bit low. I don't drive a whole lot, so mine is, I think, is even lower than that. So that would be $4,800 a year. Okay. And by the way, where a number is in italics like this, that means it's an estimate. Okay. And then you have your car insurance. So insurance is very expensive these days. Let's put in insurance at $5,000 a year, although that may be pretty low. Okay. And then you've got parking. Okay. And, we'll allow, let's say, 360 a year for parking. That's $30 a month. And then I realized we don't have anything in there for maintenance, so we'll put in another space for maintenance. Search. Oh, there we go. Okay, and so here's maintenance and repairs. Okay. And, that would be things like car washes and repairs, that sort of, oil change, that kind of stuff. So, I don't know, let's put in $2,500 a year for that. Not 25,000, 2,500. Okay. So those are our automobile expenses. Okay. Next is healthcare expenses. Now, it may be, since this is a part-time business, that you haven't, well, not maybe, then you have another job, and maybe you have insurance through your job. Okay. So in that case, health insurance cost would be, in terms of premiums, would be zero. Okay. But maybe you have some other insurance that's, for example, long-term care insurance. Okay. So long-term care insurance is if you get in a position where you can't work and you need some income to replace your lost income. Basically, it helps pay for the care. Okay. And it depends on when you buy it and all those kind of things, but let's estimate it at $200 a month. So 24. What happened? I bumped something. So let's put it at $200 a month, or $2,400 a year. Okay. And then here's the thing: even when you have employer paid health insurance these days, typically you still pay a deductible and co-pays. So you can still pay for your health care through your business. Okay. And it becomes a deductible expense. And so let's say you've got a family deductible of, I don't know, $3,000 a year, and you've got co-pays that can equal up to $7,000 a year. So your annual out of pocket for healthcare is $10,000. Okay. All right. Next, internet service. So depending on what your business is, you're probably going to be using internet service as part of your business, either for marketing or for doing research, whatever. Okay, so internet these days, it's going to be around $100 a month, maybe a little bit more. So let's put it at $110 a month. So that's $1,320 a year. Okay, now maybe you have life insurance. So if you pay for life insurance personally, the premiums are not deductible. But if you pay for life insurance through your business, the premiums may be deductible. Okay. These, on some of these expenses, like the long-term care insurance, life insurance, these are things you would want to talk to your accountant about to make sure that, they're being handled correctly. But, it's entirely possible that Your life insurance can be a deductible expense for your business. So let's put your premiums at $150 a month, which is $1,800 a year. Okay, and now marketing expense. So you're probably going to do some email marketing, which might involve having a service like Aweber or MailChimp. Those are two of the best known. Maybe it's about $25 a month that you're spending there. Okay, maybe you're doing some advertising, whether it's online advertising like Google Ads or something like that. So maybe you're planning on spending, let's say, $200 a month on that. So that's $2,400 a year. Okay, oops, I don't know why it keeps doing that. All right. Next are some operating expenses. So if it's a part-time business, probably don't have an office. So you're probably working out of your home. Now, if you have a separate room that you dedicate solely for your business, you may be able to deduct the cost of that room from your business income. The way I've typically handled it, so when I end up actually paying, let me take a step back. If you have your own business, even if it's a part-time business, you should have a separate checking account for the business, no matter what the entity is. Okay, even if it's a sole proprietorship where the business is still just you and you're operating under a fictitious business name statement, you should have a separate checking account for your business. And by the way, if you want more information on business entities, I have done a show on that. I'll put a link to that show in the show notes for this one. So if you want to go look at that afterwards, you can. But in any event, you're going to have your own checking account. So if you are planning, let's say, just to make it easy, that you're renting your residence, and let's say you're going to use one of the bedrooms as your office, and that bedroom comprises 7% of the space in your residence. So then you could pay 7% of the rent from your business account, and that makes it, and that'll deduct that expense from your business income. You could do the same thing with your utilities, electricity, etc. Probably not going to deduct water and trash unless there's a separate bathroom that you're dedicating to your office. But at least rent and electricity. Now, if you own your house, you could pay a portion of your mortgage directly from your business account. Now, one of the things you probably don't want to do is pay from your business checkbook to your personal checkbook for rent, because technically that makes it so that you need to report that income you need to report those funds as income. Okay, so that's why it's better just to pay it directly to your landlord, directly to the lender, and that way you potentially avoid that problem. Again, double check all of this with your accountant on how he recommends that you do these things. Okay, so I'm just going to do, operating expenses will depend on the business. You're probably going to have some kind of cloud storage, whether it's something like Dropbox, whether it's Apple iCloud, something like that. Okay, so I don't remember what Dropbox is. I think it's $190 a year. Okay, so so there you've got that. Restream. So you can see I adapted. So I obviously I'm using Restream right now, but maybe you have some kind of file sharing service, which is kind of what Dropbox is as well. Maybe you have some other. What's another operating expense? Let's say you're in the real estate business, and so you have a membership in something like LoopNet. So that might be something. We'll just put that in. And I don't remember what LoopNet costs, to be honest, but let's put in $1,000 a year just to put. So whatever your operating expenses are. And again, you can see we're trying to keep the list of expenses fairly small. So so it's easier to keep track of them. Okay. And by the way, you could just have an operating expense category. You wouldn't necessarily have to break it down. You could do the same thing with marketing. You could just have marketing. You don't need to break it down. That's up to you. Okay, professional services. This would be like legal and accounting. You're probably going to have an cost for an accountant because he's going to prepare your tax return. Let's say $500 to do that. Okay. Publications. I get the Wall Street Journal every day. You may, have an online publication or something. I think the Wall Street Journal is about $725 a year now. Oh, research. Okay, I'm actually gonna take this one out. Here, we'll do it this way. Okay. Okay, and then finally, salary. So there's a couple of ways to handle this, but the way that I typically handle it is on for a small business is maybe you're going to take draws on a monthly basis based on your net income. So you can see the net income right now is about $23,000. It's obviously going to be lower than that. So maybe you're going to have net income of about $18,000. So maybe you take a draw of $1,500 a month. And then when you close out your year, which let's say, just for sake of argument, you're on a calendar year, so you're going to have to pay payroll taxes and convert your draws to salary. Okay, and payroll taxes, so you're going to pay essentially what amounts to self-employment tax, because you're going to be paying both the employees and the employer's share of income. So let's just, for the sake of argument, let's just estimate your income at $18,000 a year. And I'm going to look up I meant to look up the self-employment tax rate again. Yeah, 15.3. Okay, so we can calculate that here. So we'll have $18,000 times 0.153. Okay, and you can see it's about $2,700 thereabouts. Okay, next is telephone. So you probably have a cell phone. I do recommend that you have a separate cell phone for business, and that way you don't have to worry about being able to sort of cordon yourself off from your business day. These days, cell phone costs, of course, vary widely. Let's just put cell phone costs of $150 a month. So that's $1,800. Okay. And then, perhaps you have some travel expenses, depending on what your business is. So let's just put in $400 for travel. And that, coincidentally, that puts our payroll taxes that we calculated it based on $18,000. We're pretty close. Let's just see if we change this to 1801. Okay, so yeah, so it's it doesn't really change it. So I'm gonna take that out. But okay, so we have $18,000 in net income from our business. Now you see over here under our personal budget, then the business income has already been inserted. Okay, and you'll also note that we're deducting our income tax from our income, so that when we do our personal expenses, we do so on an after-tax basis. Okay, so we don't have to worry about, hey, we haven't set aside for taxes. Okay, so I calculated personal income taxes at 25%. It really depends. If you're in a state like California, okay, and you're at the lowest federal bracket of 15%, still you could easily be in the 10%, which is close to the highest bracket here in California. Now, depending on what your overall income is, that the 25% income tax rate may be too low. Now, keep in mind that the way income taxes work is they're what's called progressive, meaning as you earn more money, a higher rate is applied, but it's not applied to the total, it's applied to the next increment of income. So although you may be, for example, in a 28% tax bracket, the tax rate on your overall income is going to be lower because chunks of the initial chunks of income are taxed at a lower rate. Okay, so keeping that in mind, now let's figure out the personal side of things. So here's where you'll put your salary. Now this is your this is your salary with after deductions, but not after income tax. This makes it a little bit tricky, okay? Because if you put your let's say that you get paid $6,000 a month, okay, which is $72,000 a year, okay. So, oh, that's weird. Okay, it took the wrong one. There we go. Okay. Oh, I know. Okay. You know what? That's right. I set this up differently. So actually, the number you plug in here is your take-home pay. Okay, so I'm going to note this. That's right. Okay, so that way all of your taxes are accounted for. Okay, but this is your after-tax number. Okay, so if your salary is $6,000 a month, so you know your take-home pay is going to be more like $4,000 a month. Okay, so your after-tax income is about $61,500. Okay, so let me go over that again because I realized I did set this up to make it as easy as possible. So the personal income taxes here are taken just on your business income, okay? Because this is unless you have something like a C corp, okay, where it's paying its own income taxes. If you have a sole proprietorship, if you have a partnership, if you have an LLC, or if you have an S corp, okay, the net income, your share of the net income from that business is going to be reported on your personal tax return. They're what are called pass-through entities. Okay, so when this income is reported of $18,000, you're going to have to we have to account for the income taxes on it. Okay, but for your salary, you can just put your take-home pay, and that way the taxes have already been removed from it. Now, there is, of course, an assumption here, and that is that the amount being deducted from your salary for federal and state income taxes, if you have a state income tax, is the amount that you owe at the end of the year. Okay, in many cases, people end up getting a refund. Okay, so indeed, your take-home pay is actually lower than what your actual net salary is if you were to calculate your taxes exactly. So again, this is something to talk over with your accountant to get an idea of what this number should be. Okay, but if you use your take-home pay and you find that generally speaking, you're getting at least a small refund on your taxes, then you'll be okay for budget purposes. Now, if you end up owing a lot of money at the end of the year, despite the deductions for income taxes, then you want to reduce this number. Otherwise, if to the extent that you budget your expenses, at a total of about $60,000, you're not going to have additional money to pay those additional income taxes. Okay, so what we're going to see here, what we see here are a list of expenses. Yours may be different than mine. That really depends. I'm going to take the blank spaces out and put them here. Oops. Oh, okay. One more time. Okay. Oh, it does want to do it. Okay, whatever. All right, so um, you'll see the top one I have here is allowance, and you'll see that that is in purple. That's because this is a much more of a discretionary expense, and so that one we're going to leave for last. Otherwise, you'll see they're in alphabetical order here, and that's as they are here, and that's why allowance comes first. Okay, cleaning service. So if you have someone, let's say coming in to clean your residence, so that would go there. Let's say you're paying someone $200 every 2 weeks, so that's 26 times a year times 200 is $5,200 to have your place cleaned. Okay, donations are charitable donations. So you see, I put this as a mandatory expense because that's part of my my faith background, and so let's put donations at $6,000 or 10% essentially of our net income. Okay. Next, DMV fees. So this would be, by the way, if you have a business, you can most likely pay the registration fee for your car through your business. So this would be for like renewing your driver's license. And the reason I have you budget in these kind of fees is they keep getting higher and higher. So there's if you have a professional license, I know my professional license fees all went up this year. In one case, it doubled to $1,300 for my professional fiduciary fee, which is an enormous fee, frankly. Okay, so DMV fees, let's say it's $100 to renew your driver's license. Dry cleaning. So you may not have dry cleaning. You see me, I wear, shirt and tie every show. So I've got dry cleaning. Let's put it at $200 a month, which is $2,400 a year. Okay, entertainment. So this is, everything you do for entertainment, whether it's movies, whether it's streaming services, it may be sporting events, it may be concerts, et cetera, et cetera. Now you'll see I put it in as a mandatory expense, and the reason I do that is because look, life is stressful, and so it's good to we need to get some some kind of relaxation. So let's just put in $2,000 in entertainment expense. Actually, yeah, 2,000. That's fine. Okay. Now, you see food and sundries is in purple as well, and that's because what we spend on food and sundries can vary a lot depending on, for example, how often we eat out, and or how often we cook our own meals, how elaborate we get. Again, me, I wine and spirits is my big thing. Which raises the cost of food and sundries. So that's another one that I leave until I've budgeted the other expenses, so I can understand really how lavishly, if you will, can I eat and drink and be merry, right? Okay, gifts. So look, there's holiday gifts. You may be helping out a relative, and so again, I categorize that as a gift. And you go to a party, somebody invites you for dinner, you may want to bring a bottle of wine or something like that. So put in an allowance for gifts, more or less. So let's put in $600. Okay. Next is insurance. So if you're renting your residence, you're going to have renter's insurance. If you own your residence, so then you're going to have homeowner's insurance, of course. And again, this can vary a lot depending on where you live, how big a place you have, what kind of personal property you have. But recognizing that insurance costs have gone up tremendously in the last few years, So, it's probably going to be a pretty significant expense. Renter's insurance used to be pretty inexpensive, but it's really not anymore. But it really depends. If you live in a state like California, you may need earthquake insurance, even if you're a renter. Okay, because if you're renting, the owner of the property you're renting will not cover your contents, your personal property, if there's an earthquake and some of it is damaged. Okay, so you're going to want to get renter's insurance and perhaps broader. This is something to talk to your insurance agent about. So let's put in $2,400 for renter's insurance. Okay, next is credit cards. Now, presumably, interest on your credit cards is 0. Okay, that's what you want to get to. You don't want to be running credit card balances. Okay, and it's fine to use credit cards, just pay them off each month. And when you do that, you don't have a credit card expense because what you're buying on that credit card should fit into these other categories. Okay, so I know for me, I pay all my utilities through, but by credit card. I pay for food, cleaning, dry cleaning, everything basically I put on a credit card, and then I just pay the bill off at the end of the month. Okay, now let's say you've had an emergency expense, maybe an emergency medical expense or something else. Okay, and you are running, you have a balance on your credit card that you're paying off. Okay, again, the expenses from the credit card still get reflected in your budget items, but there needs to be a place for the interest you're paying on the credit card. And also, by the way, if you have a credit card fee, like an annual fee, although technically that's not interest, it's an expense of having the credit card. So, you may have a $50 a year fee, or you may have some interest as well. Okay. Now, there's lots of no fee credit cards, and of course, those are the best. But in any event, this is something you would have to fill in depending on your personal circumstances. Okay, next, landscape maintenance. So if you rent a house and or you own a house, you may be paying for landscape maintenance. Okay, maybe that's $150 a month. Okay, now maybe the owner of the property pays for it, and so you don't have to, you don't have that expense. Doesn't really matter, as long as you account for the expense that you're paying. Okay, next is utilities. So, this is going to vary somewhat which categories you have. Now, by the way, you could just have a utilities category in which you lump them all together. Okay, here in Southern California, so we have the Southern California Gas Company. In Los Angeles, we have the DWP, Department of Water and Power. So it's one bill every other month for all of this. And then you have your gas bill. I know my gas bill is not very expensive because I only use it for heating and cooking. But electricity and water and trash here in LA is exorbitantly expensive. It's, on the neighborhood of at least $2,000 a month. Okay, so there you go. So so now we've got to go back, and we've got not quite $17,000 a year left, and we have to plug in for food and sundries and maybe an allowance. Now, by the way, you don't see shoes, clothes, jewelry, that kind of, because that all comes through your allowance. Okay, this is the money you can spend on whatever you want, but that includes things like clothing, unless of course there's some kind of clothing you need for your business, in which case it would be over on this side. Okay, so even if you were to spend $1,500 a month on food and sundries, you'll see you end up with a negative number here, right? So you can't spend that much. Now, this budget appears to be for a single person, so maybe $1,500 is too much, but let's say you spend $1,200 a month on food and sundries, which is about $300 a week. So that's going to be $14,400. Okay, and you're left with about $2,360. So if you give yourself an allowance of $1,800 a month, Well, there you go. You're in positive territory. Now you may notice that there's one more thing that hasn't been budgeted for, and that is any kind of saving or investing. Okay. And that's problematic. Okay. Unless you have some kind of um, pension plan at work where maybe you're building up a 401k, so you're saving, at least saving for retirement there. You know, while you're living in your current means, you're not planning for the future. So the question then becomes, well, where can you cut back? Okay. And this is why, this is where, you need to start looking. And the first two places to look are allowance and food and sundries. Okay. So you may decide, you know what? I'm going to get my enjoyment out of life from what I currently have, plus my, having a nice meal once in a while, maybe, going out to dinner once a week. And so I'm going to reduce my allowance to just $50 a month, okay, which ends up being $600. Okay, and now I've got about $1,700 a year to invest. Okay, and maybe further, instead of spending $400, I'm sorry, $300 a week on food, I'm going to spend $250. So that'll reduce this to 12,000. Okay, and now you've got $4,000 net income that you can save and invest each year. Okay, and the idea is and I've talked about this in another show. You first want to create a rainy day fund of at least a month or two of income, so that if you have an emergency, you don't have to use your credit cards and carry a balance in order to cover that emergency. Okay, so in this case, your monthly after-tax income is a little over $60,000. So you want to have between $5,000 and $10,000 in savings for your rainy day fund. Okay, so you can see that it's going to take you a couple of years to get, to accumulate that, but that's okay. The other thing that you may do is you may say, well, I want to save more. I'm going to be, kind of frugal here, but I still want to save more. What if I work in my business 20 hours a week? Okay, so that alone, even though you see your income taxes, almost double, the income taxes on your business almost doubles because your net income um, uh, doubled, right? Because your expenses really don't change a whole lot with income. Maybe you have a little bit more automobile expense or something like that. Maybe you have a little bit more marketing expense. So let's say you double your advertising to get more business. And you're driving more, so now you're spending $500 a month. Even so, you're making more money, and now you have over $15,000 a year available to invest. Okay, and now you may say, well, I'm working a lot more hours outside of my salary job, so in that case, I'm gonna make my allowance $100 a month. That seems fine, and I'm gonna take this back up to $300 a week. Okay, still you've got over $12,000 or over $1,000 a month that you can save and invest, and that's pretty good. That's 20% of your take-home pay. Okay, that's a nice amount to save and invest each year. Okay, and this is what's nice about having a budget in a spreadsheet like this is you can easily adjust and do some what ifs. Now here's another what if. Okay, are you going to be able to get 20 hours of work a week at $75 an hour? Okay, for 50 weeks out of the year. Notice I only do 50. I'm assuming you're going to take a couple weeks off from your business. Okay. Now, by the way, maybe at $75 an hour, after several months, you find that you could easily be, working 25, 30, even 40 hours a week at your business. So now you've got a decision to make. Do you want to start? Do you want to make your business your full-time occupation? That's one option. Okay, so let's look at what would happen there. So let's say you start working 40 hours a week in your business. Okay, and you quit your job. How does that? Okay, well, that looks like a good decision because now you're earning, you've got $21,000 a year to invest. Okay, so that's one possibility that you can do. The other next one is maybe you really like your job, you see a lot of long-term potential there, so you don't want to give up your job to work in your business full time, but you've got a lot of business. Still, you're content to work at your business 20 hours a week. So what can you do? Well, maybe try raising your hourly fee. Okay. And what typically when we raise our hourly fee, okay, what that does is I'm gonna okay, what that does is some people are going to drop out. Some clients are going to drop out because you're too expensive now, but that's fine. Whereas you may have been working 30 hours a week, maybe you lose a client or two if you increase your fee to $100 per hour, and now you're back down to 20 hours per week. But still, you're making, you're making a lot more money, and and that's good. Of course, you're paying a lot more taxes. Fine, no problem. But look, now you've got net income of $30,000 a year to save or invest. That's over $2,500 a month. So this is the kind of what if planning that you can do with a budget as well. And this is why, again, I encourage you to do your budget in a spreadsheet like this. Now, you may not be, particularly good at building this kind of spreadsheet, and if so, feel free to send me an email. I will email to you an Excel document that had this basic outline, the way it looked before we filled in all the numbers, and you can certainly fill in the numbers and start playing around with this the way I've just been showing you. Okay, and again, if there's any particular item that doesn't apply to you, so you could just delete it, like LoopNet. Maybe you don't have LoopNet, but maybe you have some other operating expense. Okay, it doesn't. You can put that in there, or again, you can just lump together all of your operating expenses. Yeah, you could just lump all your operating expenses together the way I've set this up. So you'll see 1190. If we put that in there and take these other two out, it gives you the same result because it's just adding up all the expenses that are here. Okay, so this is what I recommend you do. And then if you're using a tool like Quicken or whatever, so set up your Quicken chart of accounts the same way they're set up in your budget. Okay, and that way each month you can do a Quicken report, and you can see how you're tracking. Okay, so this budget is done on an annual basis, and I think what I'll do in the spreadsheet that I give you is I'll put in we've done this on an annual basis. With the spreadsheet I give you, you can make a second copy and you can do it on a monthly basis, so you can track your expenses month by month, however you want to do that. Okay, but the main thing is that you have a basic budget, so you track your income, you track your expenses, because the key thing is here. This is what you want to you want this to be green. Okay, well, that's too dark to see. Let's put it. Let's see if we can get a lighter green here. How about that? There you go. So you want this. You want to be in the green, right? Now, by the way, the reason loss is in parentheses is I'm just going to change this. Let's say as gifts you're giving $40,000. See that's what this is, a negative number when it's in parentheses. That's an accounting thing. Okay. By the way, I don't recommend you give $40,000 in gift when your after tax income is $91,000, obviously. But in any event, this is the key number that you want to look at. Okay, so now, by the way, this number is also important. You don't want you don't necessarily, well, you've got to be careful about running a business at a loss, especially if it's a sole proprietorship, because if you run a sole proprietorship, a so-called Schedule C business, consistently at a loss, so the IRS might decide to redesignate that business as a hobby. And so all of the deductions you took from that business now become taxable. Okay, so in general, if you have a side business, the goal is to make sure, it's fine to have a big profit, of course, but to have at least a small profit each year. Okay, so that you can legitimately be writing off your expenses. Okay, and that's one of the reasons why, by the way, people start side businesses, is it helps them reduce their taxes. So notice that you have almost $42,000 in expenses here. Now, you may not have all of these same expenses without the business. For example, you wouldn't necessarily have payroll taxes. You might not have the marketing expense. But notice that a lot of these expenses are expenses you're going to have regardless of having a business or not. So if you need to pay $40,000 in additional expenses, keep in mind that if that were coming out of your salary, then you would have to pay on top of that you're going to pay double this taxes, plus you're going to pay, you're not going to pay double these taxes. You're going to be paying income taxes on this number. So if you're in if you're paying overall 25% taxes, basically you need another roughly $13,000 in income if these expenses were being paid personally. So you can see it's a big tax savings to have a business and be able to legitimately, and this is what you want to talk to your accountant about, legitimately write off these expenses. Okay, so that is your basic budget, and we're going to stop sharing, come back over here. So I thank you very much for joining me. If you have questions, comments, please feel free to post them in social media. All the links will be in the show notes after the show posts. And if you've got a personal question or you want a copy of the spreadsheet, unfortunately, I can't put a download link in the YouTube notes, but my email address will be there. Just shoot me an email and I will be happy to email you the spreadsheet back, and you can start working on this yourself. And again, if you have personal questions, I'm happy to answer them, as long as they're, as I always give this caveat, as long as they're in my area of expertise. So if it's legal or accounting advice you're looking for, I'll be happy to refer you to a lawyer or an accountant. I'm neither, and so I don't give legal or accounting advice. All right, so that is the show for today. Now, normally Wednesday is my last show for the week, but tomorrow is Independence Day here in the United States, and I'm going to be doing a special show for Independence Day. So it has been my practice for quite a number of years now that on Independence Day, the 4th of July, which is the essentially the birthday of the United States of America, to read the Declaration of Independence. So, the Declaration of Independence was originally approved by the Continental Congress on July 2nd of 1776, and it was essentially published on July 4th. Okay, now if you watch like the show 1776, it makes it look like everybody signed it on July 4th. That's historically not exactly accurate. Some of the signers actually signed it afterwards, but July 4th was the day it was published to the country, and the day that the United States was established as a country. And I think it's important for us to remember why our founding fathers decided to break away from the mother country, England, and establish our own country. And that's essentially what the Declaration of Independence does. So it talks about the fundamental ideals of the United States, and it talks about the grievances that the founding fathers had with really King George. It really wasn't England per se, because they didn't want to alienate their the English people. Okay, and then it established the country. So I think it's important to at least once a year read this document and understand what our country is all about. So I invite you to join me tomorrow, Thursday, July 4th, at 10 a.m. All the way to WOW shows are at 10 a.m. Pacific time. And I'm going to be reading the Declaration of Independence, and join me in this tradition. Okay? So, and then tomorrow will be the last show for the week this time. And then starting next week on Monday is my show, Trust and Estates Weekly. On Tuesday is Business Lessons from the Military. And then a week from today will be the next edition of People Making Money. So I thank you very, very much for joining me, and wishing you a wonderful rest of the day, and looking forward to seeing you tomorrow for a special Way to Wow show. All the best, folks. Oh, I didn't do my regular sign off, and I should, especially on this show. Marie